I would say that I do not think bonds are safe anymore. And this was the genesis. My belief that bonds would no longer be safe was the genesis of the dollar milkshake theory. Remember, the whole genesis of the milkshake theory was that I thought the 40-year bond bull market was coming to an end and interest rates would rise. I don't think that the U.S. is going to have trouble selling bonds, but it doesn't mean they might not have to have higher interest rates to sell them. But what I don't think will happen, I don't think we would have a situation where nobody would fund the United States government, but they would still continue to fund Canada or Mexico or France or Italy or Japan or wherever it was. So I think a sovereign debt crisis becomes a global sovereign debt crisis very quickly. I don't think it will just be one country. So that leaves gold, right? And I think everybody should absolutely own gold. That was always kind of one of the things I said during the initial part of the milkshake theory was gold would be the ultimate winner and that gold would outperform fiat currencies.
Brent Johnson, the macro strategist behind the Dollar Milkshake Theory, returns with a stark warning: bonds may no longer be safe. For decades, sovereign debt, especially U.S. Treasuries, was considered the ultimate safe haven. His thesis began with the idea that the 40-year bond bull market was ending, leading to structurally higher interest rates. While the U.S. may still find buyers for its debt, it might have to offer increasingly higher yields to attract capital. Johnson emphasizes that this isn't just an American issue, it's a global one. As interest rates rise, countries across Europe, Asia, and emerging markets will face similar, if not worse, refinancing challenges. In a world burdened by debt, higher rates could spark a global sovereign debt crisis. So, where do you go for safety? According to Johnson, gold. Now, we present the latest clips of Brent Johnson's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think that the United States, despite all the problems, the whole world still needs dollars. Until they reconcile all the US dollar debt, the world still needs dollars. The whole world doesn't need euros. The whole world doesn't need yen. The whole world doesn't need yuan or rubles or lira, but they do need dollars. So, and that's why I always said that we would eventually get to a point in the milkshake where the dollar would rise and gold would rise together versus all the other currencies. And I think we're probably there now. I think if I was going to own gold now, I still own gold. I think everybody should own gold. If you don't own any gold, you should probably go buy some gold. I think gold will perform better in other currencies than it will in the dollar. But I think even if you're a US dollar investor, you should still own gold. And when things get bad outside the United States, while there's still liquidity inside of the United States, I think that could draw more capital back as well. I mean, we'll see. This is pure speculation on my part. I'm just trying to think through all the different variables and how it could go. How it may be very difficult for a foreign company or a foreign investor to send new money to the United States right now. I totally get it. I think it would be even more difficult for a United States investor or a United States asset allocator to send money to China or to send money to Europe or to send money to Africa or South America. I think if anything, those asset allocators who have allocated capital to the rest of the world, they're going to bring back to America in the same way that Europe and Japan have taken capital from America back to their home market. I've been very critical of the whole BRICS currency idea. And to be clear, I'm not critical of the countries themselves. The countries themselves are big, important, powerful countries. But the idea that this handful of countries are going to, form this super cohesive union and going to issue a common currency or a common currency that they all agree to use, and then they're going to be able to enforce that on all of their subjects and companies. I think people who believe that don't understand how currency markets work. And what I would say is the process of so money in the financial system that we have now, money is loaned into existence. So the way the US dollar has spread throughout the world is by the extension of credit. So if you are going to reverse that and de-dollarize, what that means is you are going to deleverage. So that means you are either going to pay off all those debts that you have, or you're going to default on all those debts that you have. One way or the other, de-dollarization is deleveraging. And in a deleveraging, the currency involved typically rises. So I think that we are headed towards some kind of an event which forces some kind of a new system or a reset or a debt jubilee or some kind of event that deals with all the debt. But I don't think that process happens with the dollar going lower. I think that process happens with the dollar going higher. And in fact, I think it's the dollar going higher that forces that to happen. If the dollar falls, that means it's getting cheaper. And it means it's in high supply. If there's no supply of dollars, then the dollar would rise. But if there's plenty of supply of dollars, that means more dollars are being created. But more dollars being created means more dollar loans are being created. And so while in the short term, it provides relief, in the medium to long term, it just creates more demand for dollars. And I think this whole euro dollar system is a monster that got away from all the central banks. And it's grown to such a problem that it is now a Gordian knot. Alexander the Great cut it in half and kind of blew it up. I kind of think that's the only way to solve this Gordian knot as well. And I think in that big explosion, I think the dollar probably goes higher before it goes lower. Let's say that interest rates on U.S. Treasuries goes higher. Let's say that they don't do QE. Nobody buys the bonds and interest rates go from 4% to 6%. Okay, so now you have to remember that all the financial institutions in the world, all the central banks, all the insurance companies, as a core piece of their balance sheet, they own U.S. Treasuries. So their assets are now impaired on their balance sheet. So the U.S. Treasury prices going down and interest rates going higher affects the global banking system. That's number one. The other thing is that if you can get paid 6% for holding a treasury, which the entire world needs because it's the basis of the entire monetary system, why would you buy an Italian treasury paying 6%? Or why would you buy an Egyptian treasury paying 8%? The point I'm getting to is if you can get 6% for owning a treasury, it forces the rest of the world to pay even more to compete for that liquidity. And so the U.S. interest rates going higher, while definitely a problem for the United States, it eventually becomes an even bigger problem for the rest of the world as they have to refinance at higher rates as well. And this kind of goes back to Trump too, with Trump and Vance and Hegseth all saying that NATO the NATO countries have to start paying for more of their own defense, and they're going to have to help pay for the Ukraine war with Russia. That's going to cause budget deficits in Europe to explode. And maybe not Germany so much because they're in better situation than Portugal, Italy, Spain, Greece. A lot of European countries, Lagarde is going to have to buy those bonds. I think it's on, or those interest rates are going to rise quite a bit. So I don't think that this is a situation, and I want to make this very clear. I'm not saying the U.S. is in great shape, and I'm not saying the U.S. doesn't have tremendous problems. They have incredible problems and incredible challenges, but I don't think that they're uniquely American. I think the world is struggling with all this stuff. I just happen to think that while the world, including the United States, struggles with all this stuff, the United States have some advantages and some tools the rest of the world just doesn't have. I would say that I do not think bonds are safe anymore. And this was the genesis. My belief that bonds would no longer be safe was the genesis of the dollar milkshake theory. Remember, the whole genesis of the milkshake theory was that I thought the 40-year bond bull. I don't think that the U.S. is going to have trouble selling bonds, but it doesn't mean they might not have to have higher interest rates to sell them. But what I don't think will happen, I don't think we would have a situation where nobody would fund the United States government, but they would still continue to fund Canada or Mexico or France or Italy or Japan or wherever it was. So I think a sovereign debt crisis becomes a global sovereign debt crisis very quickly. I don't think it will just be one country. So that leaves gold, right? And I think everybody should absolutely own gold. That was always kind of one of the things I said during the initial part of the milkshake theory was gold would be the ultimate winner and that gold would outperform fiat currencies.
As Brent Johnson sees it, we are moving toward a financial event that forces a global reset, one where the dollar rises, not falls. Ironically, that rise may be the trigger that breaks the current system. In the face of rising debt, geopolitical strain, and fractured capital flows, gold becomes the anchor. It's not just about inflation or collapse, it's about capital preservation during deleveraging. Whether you agree with Brent's Dollar Milkshake Theory, it's a framework worth considering in today's environment. Share your thoughts on Brent Johnson's analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.